We are back, everybody. Welcome to Kickin' with the Rickens, redefining retirement. We are locked in, ready to load with Gerry Ricken and Heidi Ricken-Provost, retirement planners and the runners of, if you will. I'm going to give you titles, the chairman and CEO of, because people do that with their own business, right? Of Ricken Financial, and you can get in touch with them at rickenfinancial.com. They're located in St. Louis, and you can dial the office as well, 314-442-6476. They're helping protect and preserve the retirement you deserve. I'm your co-host, Doug Turnbull. Heidi, Gerry, how are we doing today?
Hey, great.
Good, Doug. How you doing?
I'm doing great, thank you. I just got back from, you can hear the smoke in my voice a little bit, calling some NASCAR races this weekend on Performance Racing Network at Atlanta Motor Speedway, my home track, and I get to do it again this coming weekend in Austin, Texas at Circuit of the Americas there. So
cool.
That's awesome.
We'll be running on fumes here for a couple of weeks, especially on these Mondays. But I had a big weekend, but you all are out helping people, all right? Y'all, I mean, I'm helping entertain people, but y'all are helping people. What was the event that y'all tackled this past weekend?
Well, we had the pleasure of being one of the sponsors this past weekend of Cocktails for Camp, which is the large fundraiser that Camp Rainbow does. And for those of you who haven't heard about Camp Rainbow before, it is a local St. Louis charity that helps local children in our community who are faced with childhood cancer and their families. So we're very passionate about Camp Rainbow because we lost my sister to childhood cancer many years ago, and to keep her memory alive and to bring, some positivity to the situation, we take a week off every June and volunteer at SIBS Camp for the super important brothers and sisters of kids with cancer. So it was awesome. We got to come together for a great cause and raise a lot of money. And more importantly, I think we did a lot of friend raising too. So, when you're in the nonprofit world, you fundraise and you friend raise. And it was really cool to see a bunch of new faces learning about the organization.
There were a lot of new faces there, and it was really, really cool. So it's just an honor to be involved with an organization that provides such great services to these kids.
Oh, yeah. And we got to hear from one of the campers herself, Lincoln. If I had to guess, she's probably 5.
Yeah.
Oh, she was so cute.
So cute.
So cute.
That's so cute. I love that. I love that you give back and pay forward in a community that you benefited from as you dealt with Mary Beth's death so many years ago. And Gerry, you all have just vast experience in this field of financial advising, but there's got to be a parallel with nonprofit fundraising in the relationship factor. You talked about friend raising there, so could you speak to that?
Oh, absolutely. When you are in business, in the business that we're in, we're not in the financial world. We're in the people world.
Yes.
So it's all about developing friendships and developing the relationships with people that you know, like, and trust. And it goes the same way in the not-for-profit world. Like, and trust the organization and the people running it. You're going to be a supporter of that organization. And the same thing goes for business.
That's fantastic. And you all, it's just obvious. It's written all over every social media post. Get on Facebook and Instagram with Ricken Financial. It's written on every bit of information we squeeze out on this podcast here, that the relationship, the importance, the warmth of people is really what is the secret ingredient, if you will. We just told the big secret, but the secret ingredient of Ricken Financial.
Oh, yeah.
Oh, my gosh.
Hey, but I know,
Spill the beans.
Doug, you couldn't be there with us, obviously, because you were calling some NASCAR. But one of the activities that we do at each of our camps is a cakewalk at the different events. So it was Cocktails for Camp. So we did a booze walk, and so you didn't get cake, you got alcohol.
How did that 5-year-old fare? Did they? Okay.
They were the only.
There's an age limit on that one.
They were the only child in the room, just so that everyone is aware. They were only there to speak, and then they left. Only the adults were partaking in the alcohol.
Right.
But I do have to share that when I won the booze walk, I was gifted a bottle of Fireball. So you were there with us in spirit.
Hey, I had a group of campers next to me that were, I was standing on a scissor lift looking over the racetrack, just to relate to what you just said, okay? And right before we had to call a doubleheader of races on Saturday, all right? So long day. Right before the first race, and the guy was already hammered, Jimbo's his name, and he goes, and they had listened to me on WSB radio here in Atlanta for years. That was kind of the connection. And he goes, "Hey man," and he's trying to throw me a little mini bottle of Fireball up there. I'm like, "Bro, I'm working. Like, what are you doing? Like, this is not going to go down." Yeah. Now, after the second race was over and I lowered the scissor lift, I said, "Come here, homeboy." I grabbed one right out of the trash bag and finished it off. So there we go.
Oh, yeah.
That's how we do. All right, I'm a classy guy. Okay, but like, hey, last episode we've been in the middle of this really great series. All right, it's hard to get hyped up about taxes, but we're in the middle of this really great series about tax diversification, and we've gotten now basically we did an overarching part 1. And we're now down to, I think it's part 5 today, okay? So in the last couple of episodes, we talked about non-qualified accounts, maximizing your tax benefits, if you will, out of those, and also capital gains and net unrealized appreciation, term I did not know until Heidi and Gerry told me about it. Today, we're going to get into tax loss harvesting, Heidi, and municipal bonds. So pop the top. Here we go.
Oh,
Well,
yeah.
when I think about harvesting, I think about the summertime and the wheat harvest in the state of Kansas, which is where I grew up. But this, and we have a lot of fun during harvest, and we can also have a lot of fun during tax harvesting as well.
Oh, absolutely. Because it's a way that you can, when you are taxed, we talked about this before, you either have your ordinary income or your capital gains. And capital gains rates, we know, are usually a little bit less than ordinary income as long as you fall into the different brackets. But here's what tax loss harvesting is. You can either have a capital gain or a capital loss. And sometimes, people might lead with emotion and try to time the stock market and find themselves at a loss. You may have invested in a REIT in the past, a real estate investment trust. I'm just using a few examples I have seen in our own practice, but sometimes those lose value because the real estate market is incredibly volatile and you have a loss. Now, when you're talking to a lot of people in our industry, they'll say, that's just a paper loss.
There is no such thing as a paper loss in our world.
Okay.
Because if it's your money, it's your money.
Exactly. And if your account value diminishes on paper, we view that as your funds diminishing too. It's not just a paper loss. This is an actual loss that you have realized in your life, and you have lost funds on this. So what is tax loss harvesting? Well, sometimes you can only take up to $3,000 per year as a deduction on your income tax return from a large capital loss. And then each year you can carry that forward. Well, outside of that, how do we lock in some of our gains without having to pay tax? Well, if you have a loss available out there, and say, your portfolio lost $40,000 at one point in time, instead of piecemealing that $3,000 per year of capital loss carryover that you get to take, in any given year, as long as it's like for like long-term, or short-term capital gains, you can actually realize your gain without paying tax on it. So say you have an account right now that's gained $37,000 and you had $37,000 carrying over from that $40,000 capital loss. You can sell that at a gain of $37,000 without paying a penny of tax on it by offsetting that carryover loss.
So if you had a bad year and followed up by a good year, it can end up balancing out.
Absolutely.
That's exactly right. And it doesn't have to be a stock that you sold in the past at a loss. It can be any capital asset.
Okay.
It can be a piece of real estate. It can be a business. If you had a loss and you have that loss carry forward, you're able to use that and offset the gains with that loss and not pay any tax.
That's very interesting. And then if it was the vice versa, this is very elementary understanding coming from this guy here, okay? If it's vice versa, the first year, oh man, I paid a ton of taxes, and then the next year it's gone down. It's not retroactive, I guess, right? It's really what to do within that tax year, I guess.
Correct. And it doesn't have to be year to year either, Doug. Say you have, everyone's portfolio at some point in time has had a dog in it. You look at it and you're like, oh my God, I thought I was going to make some money in this damn stock and I've been holding on to it forever and it's at a loss and it's gone down. You can sell that at a loss and sell something that's outperformed what you thought in the same year as a gain, but you harvest that loss so that the gain isn't taxable. And then some people will say, well, I don't want to sell what I have at a gain because it's a good investment and I want to stay invested in it. You can sell it at a gain, rebuy it right away, and not have to pay tax on that by harvesting the loss against your gain.
I see.
So you can still have that same holding that's doing really well for you And it's a way to kind of take care of those dogs in your portfolio and boost it back up without having to pay tax.
Another example we've seen in the past, Doug, is inheriting stock, company stock from your parents, your aunt, uncle, whoever it is.
Yeah.
When you inherit that, you inherit it at the value on that day. And actually, we had this happen a few years ago. This couple had inherited a lot of stock from the corporation that the father had worked for, and that stock was highly valued at the date of their, the inheritance, which is the date of death. Then the stock dropped tremendously. They sold it at a loss, created it because they got it for free, basically. It's free money. They sold it at a loss. Then they were able to use that loss and offset other gains in their portfolio.
Other gains.
Gains from other investments in their portfolio. So there are a lot of creative ways that you can utilize tax loss harvesting.
And the coolest part about that was they were able to buy that stock for a smaller price too, and take advantage of some of the other gains that they had. And that stock went back up too and appreciated. So it's really cool because, the woman in the relationship, she got to keep her dad's memory alive because she stayed invested in what she inherited from him. And what Gerry was alluding to earlier, when you have this non-qualified account, we talked about this earlier, on the date of dad's passing, when it came over to her, that's how she inherited the cost there. So there's something called a step up in tax basis. And the date that dad passed away, whatever the value of the stock was on that day, is what she inherited. So since it was highly inflated that day and then something happened in the news and it made it go down, she got to take advantage of, exactly rebuying that stock at a lower cost and taking care of some of the gains that they had on their books too.
And she would have never known that had she not spoken with us. Because we realized what was happening. We said, hey, you have an opportunity here. Let's take advantage of it. Because anytime there's an opportunity in tax law, we want to just make sure that you're aware of that and you make an informed decision.
And on that note, I think we need to share something really important when it comes to tax loss harvesting, because we see a lot of common misconceptions in our practice, given that we've prepared taxes for so many years and we talk about the tax, returns. A lot of people think if they have a traditional IRA and one of their holdings in that is a dog and loses a lot of money, that they can take advantage of tax loss harvesting in that. I just wanted to let you know, tax loss harvesting applies to capital assets and non-qualified accounts. You cannot tax loss harvest in an IRA.
Interesting.
Because
or a 401k.
Exactly,
Or a
401k. Those
anything.
traditional accounts, you can't tax loss harvest in that because any penny that comes out of your IRA is taxable. So there's no way to do tax loss harvesting in an IRA, 401k, those traditional accounts.
Yeah, basically it's like capital gains is taxes on money that you've already paid taxes on in a way, right? Whereas they've got Uncle Sam's going to get at least their first swipe at your stuff there. And then so have we covered it all for tax harvesting, and how does it parlay then into municipal bonds?
Yeah, we really kind of have. And, tax loss harvesting is one way to reduce or eliminate some taxation in your portfolio without necessarily losing any benefit. You can still have some gains and offset them with tax loss harvesting. Well, what else can you gain in and not have to pay tax on? Municipal bonds. So municipal bonds are bonds that you purchase in a municipality, and they are tax-free in the eyes of the government. So it's a way that you can earn some money in your retirement and not have to pay income taxes on municipal bonds. Worth noting, there are different risks associated with a municipal bond than anything else because it's with a municipality, and you need to make sure that they're solvent and everything, the funding behind it.
So many municipalities have underfunded pensions. They're in trouble. So you need to be very, very cognizant and very, very careful in doing your due diligence when you pick a muni bond.
And also worth noting, municipal bonds may be free of income taxes. However,
there is a hidden tax out there.
There is a hidden tax on muni bonds. So Social Security, the way that income is taxed, so when you get your Social Security retirement benefits in the future, you take your adjusted gross income plus half of your Social Security amount plus any money made from municipal bonds. And then you figure out how much of your Social Security becomes taxable. So while you may not have to pay income taxes on muni bonds, it may cause more taxation on your Social Security. So just things to note, but it's another income tax-free opportunity in your portfolio now through the future is a municipal bond.
A really transparent way to look at it. I mean, a catchy way. Pros and cons of municipal bonds, right? I mean, there's the good and one tax you avoid, but the bad potentially in solvency of the municipality, or that's enough syllables, right? Or just the fact that it could affect how much you're taxed under Social Security. So there are a lot of intricacy here as we get deep into this tax diversification, y'all. How in the world do people get in touch with you and start that first conversation to piece through it?
Well, let me tell you, if we said it once, we got to say it a million times. And if you hear nothing else, listen to this during this podcast. Every single tax situation is completely different. It's like you have a fingerprint and your hair DNA, because a fingerprint's not just different enough person to person for your tax situation. Some of the stuff we're talking about on this tax diversification, which is just really how to diversify all of your holdings so that in the future you may be able to reduce your taxation. Some of it's going to apply to you. Some of it may never apply to you. How do you know what applies to you and what you can take advantage of? Well, pretty simply, pick up the phone and call us at 314-442-6476 or head on out to rickenfinancial.com, RICKEN financial.com. You can go on any of those pages and say, hey, I just want to chat taxes or whatever it is you want to say. I often joke, throw a carrier pigeon our way, hit us up on social media. There are so many different ways that we can communicate nowadays, but all it's going to cost you is a little bit of time, because we do all of our consultations completely complimentary, because we don't know if we can help you until we take a look at everything and see if there's anything we can do to assist you on how to better diversify your taxation risk for the future.
And when you think about tax diversification, it is really the things you don't know. That there are opportunities out there. So you don't know what you don't know. So please call us at 314.
Also worth mentioning, who knows what point in time you're listening to this and tax law could have changed. So
that's true.
That's one that's true. The one constant in tax law is change.
Yeah, for sure.
Yeah, so give us a call to see if any changes will impact you in a positive or negative manner.
Both in how tax law changes in Congress and just the fact that, hey, there's a lot of staffing fluctuation at the IRS. You going to go to them and get that advice, right? I mean, probably not. You need to get people that have been in the business a long time, have looked hard at this stuff. You, Gerry, you, Heidi, for sure. So again, 314-442-6476. That's the number to call. Hit up Ricken Financial on Facebook as well. Check out the different posts there. This podcast is available on Apple, Spotify, other podcatchers as well, and on YouTube. I love it's conveniently there. So we can get in all spaces. You can get in touch with the Rickens and learn more about it. And we're deep in this series here. I know I've learned a lot, and I know a lot of people have too. So thank you both for sharing your time and expertise here. And I look forward to, learning more.
Our pleasure.
Absolutely.
Pleasure's mine. We also thank our listeners as well here to Kick It With the Rickens, Redefining Retirement, and our producer, Brandon Benefield, who gets everything all polished up and ready for show. Well, we'll end it on this high note, of course. Gerry, every day
is a holiday.
And Heidi, life is short.
Laugh hard.
Thank you all for listening. I'm Doug Turnbull. She's Heidi Ricken-Provost. He is Gerry Ricken, and you've been listening to Kickin' with the Rickens, Redefining Retirement. We'll have more in this great tax series here coming up.
Insurance products are offered through the insurance business Ricken Financial LLC. Ricken Financial LLC is also an investment advisory practice that offers products and services through Impact Partnership Wealth LLC, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Ricken Financial LLC are not subject to investment advisor requirements. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Ricken Financial LLC is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Ricken Financial LLC.
Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.
Tax preparation and tax advisory services are offered through Ricken Financial. These services are not offered by IPW and are not subject to investment advisor requirements. These services referenced are an outside business activity not offered through or supervised by IPW.